Welcome to the iAIM Investment Management Equity Update. My name is Rose Marcello and I'm Director of Client Portfolio Manager with iAIM. With me today, I have Jean-René Adam. Jean-René is Senior Vice President, Head of Public Equity. He leads both the fundamental and quantitative equity strategies. Good morning, JR. How are you today?
Very good. Thank you, Rose.
Well, end of the year, time to kind of have a little wrap up. Equity investor sentiment is at a low. We know from the last fund manager survey that investors are overweight bonds versus equity, and they are sitting on comfortable cash when you consider historical averages. Given that somewhat bleak positioning in portfolios, a question that many have right now is it time yet? Meaning, is it time to put some money to work in stock markets?
Yeah, so the sentiment you just alluded to is always a positive sign, right? And especially for contrarian investors. But I would say the most compelling reason to be bullish equity right now is the fact that the risks are well known. Everyone is aware of the problems the stock market is facing, which are, high inflation, interest rate that continue to increase, at least central banks continuing to increase interest rate, economy that might fall into a recession, which would lead negative earnings growth next year. Given the fact that investors are well aware of these risks, it becomes somewhat priced into the market and the odds of negatively surprising the market are reduced. On the other hand, positive surprise become easier to get when everyone is bearish and expecting a difficult environment. And so I would just bring the example of the what happened lately with the two last inflation numbers we got out of the U.S. So October and November. So inflation came in lower than expected, and we saw a very strong rebound from the stock market by more than 10%. It was very quick and very strong. And so why is that? I think it's because it was an unexpected positive surprise. And I could draw a parallel with the situation in a widely expected recession somewhere next year. I think we can safely say that it's probably one of the most telegraphed recession ever, as everyone is expecting it. What happens if we're able to avoid it and earnings don't contract next year? How the market will react to that? I would think probably the same way it reacted with inflation, would see kind of a relief rally. And I'm not saying we're going to be able to avoid the recession. I think that chances are we're going to go through it, but I'm saying it wouldn't come as a surprise, which is what the market hates the most, unexpected bad surprise. Having said that, I wouldn't advise to buy the stock market blindly because yes, there are great opportunities, but some segments are still unattractive, I think.
Okay, so a tilt to the positive, but we're very cognizant of where the risks might be. Good. So you and I have spoken about valuation quite a few times in the past year. And as we head into 2020, 2023, what are the sectors that you would favor or would you avoid?
Yeah, so let's start with the positive sector, the one we would recommend. I think that technology stocks, which have been one of the worst performing sector this year, we think it could rebound in 2023. So what happened this year? Obviously, sales disappointed. So the growth in sales was below expectation. And then you had a multiple contraction that, let's be honest, was overdue, right? Technology stocks were very expensive. And now the good news is that these tech companies have reacted very quickly to the downturn and have reduced their cost structure materially. We all heard about massive layoff in the industry lately. So just think about Facebook, Amazon, Twitter, and so on. This creates kind of a nice operating leverage that will move earnings upward in certain segments where we are the most bullish. So we're thinking about automation, cybersecurity, and digitalization. And now in terms of sector that we would avoid, I think I would be very cautious on some defensive sectors that benefited from the tough environment in 2022. Consumer staples is a very good example, I think, as investors really flooded the sector. They were looking for safety, given the upcoming expected recession that we just alluded to, and also because it performed generally well in a high inflation environment. So consequently, as you can see on the chart on the screen, the relative valuation of the sector compared to the S&P 500, and I could have used the S&P TSX with the same conclusion, it is at one of the highest level in history, and that could reverse quickly when the market environment improve. So I would be cautious on that sector.
Okay. And speaking of sectors that have done well this year, energy. So we see now there's currently a big disconnect between energy stock prices and the price of the commodity. It's been going on for a few months now. oil has gone back to its pre-Ukraine conflict levels, but energy stock prices haven't. What's your analysis? What do you comment about that?
Yeah, it's a good question, and it's kind of interesting because most of the year we were saying exactly the opposite, right? There was oil price that was so strong, whereas we felt energy stock was still undervalued, and they were discounting WTI at $70 when it was higher than 100, right? So that was a good call. In fact, so energy stock did well, and as you just mentioned, oil price is back to $70, but all stocks have stayed pretty high. And the question is, should we sell them now? And we don't think that investors should sell them. We think that what we're seeing right now is really the WTI that we don't think reflect really the current bullish environment for oil, right? Which are, low inventories, still a high political risk given what's going on in Russia and Ukraine, and also a very aggressive OPEC that, is ready to cut production and have cut production in order to be able to stabilize supply and demand. And then if you look at valuation of these stocks, and you can see it on the screen here, they're still very cheap. They're trading at around 4x next year cash flow. And so, and if our prediction turns to be true, right, and oil price increase even more, that valuation will become even cheaper. So this is another area where we are bullish and where we see a good opportunity for investors.
That's good to know. So really short to medium term arguments explaining the actually supporting oil prices.
Yeah.
Well, thank you so much, JR.
Thank you very much, Rose.